There has been a ton of tax legislation over the last several years. The Tangible Property Regulations in 2014, the Tax Cuts and Jobs Act in 2017, the CARES Act in 2020, and several COVID-19 stimulus bills, and a whole bunch of new federal, state, and local regulations. With all of that before us, there are some tremendous opportunities for owners of commercial and rental residential real estate to implement tax planning and tax saving strategies. With the current tax-saving opportunities, it's very important to stay vigilant around any changes that may happen so that you can ensure you're taking advantage of all of the tax strategies for which you qualify. Remember, tax evasion is a crime, but tax avoidance is mandatory. Let's look at 5 important tax strategies for you to be aware of right now. Hi, I'm David Weiner, CEO of Cash Flow Strategies. They call me Mr. Cashflow because I work every day to help small and medium-sized businesses, as well as medical and dental practices, to improve their cash flow and bottom line. Thanks for joining me on this video. If it's helpful to you, please hit the like button on the video and consider subscribing to the channel to find out more ways to make your business or practice more profitable. Let me know as well what you think of this video and suggest some other topics that might be helpful to you in the comments section below. Here are my top 5 recommendations and tax planning and tax saving strategies. Number 1 is cost segregation studies. These studies are specifically beneficial to commercial real estate and rental residential real estate owners and investors, as they allow for accelerated depreciation of identified assets that may otherwise be trapped in long life building assets. Rather than depreciating your entire building over the 39 or 27.5 years, a cost segregation study allows you to segregate specific parts of the building into their proper 5, 7, and 15-year depreciation lives, thereby accelerating the depreciation, creating a large tax deduction. Currently, this opportunity is greatly enhanced with the introduction of 100% bonus depreciation from the Tax Cuts and Jobs Act, but only on those specific assets identified in a cost segregation study. The personal property and land improvement assets that are currently being depreciated over that long life period can be adjusted to a shorter life, and bonus depreciation means immediate expensing for all those items rather than depreciating them even over their 5, 7, or 15-year lives. The Tax Cuts and Jobs Act has also expanded the definition of assets available for 100% bonus to include acquired or used property. That's another huge opportunity for quicker write-offs for investors who are acquiring new property or used property. Secondly, the Tangible Property Regulations. The 2014 Tangible Property Regulations, also known as the Repair Regulations, still exist today. They've survived all the subsequent tax laws and changes. These repair regs have provided taxpayers with a new definition of repairs and have made expensing opportunities much easier. This includes things like HVAC, rooftop units, roofs, and other building units of property that previously had to be capitalized and depreciated over the long life. Even better, the expensing opportunities can be applied retroactively. An asset that was properly capitalized under the old rules that meets the new definition of expense can be written off with an automatic approval of a change of accounting method. These TPRs have also provided an opportunity to write off the remaining basis of structural components called partial asset disposition for the very first time. Prior to this change, for example, taxpayers would oftentimes be depreciating 2 or 3 roofs or more for the same building. But these regulations allow for writing off the taxes of the old roof if it's specifically identified. This is the case for all replaced structural components of a building which have been identified through a cost segregation study. Third is the de minimis safe harbor. An additional immediate expensing opportunity available includes the de minimis safe harbor that was introduced in the Tangible Property Regulations. This safe harbor allows taxpayers to deduct certain items that fall under a specific dollar threshold. This These rules, when properly elected and utilized, provide an opportunity to expense many expenditures every year that would be otherwise capitalized and then depreciated, and also provides for additional administrative convenience. The immediate expensing opportunity has been popular and allowed for the tremendous savings of taxpayers. Fourth, enhanced Section 179. This is another option for immediate expensing. The Tax Cuts and Jobs Act increased the maximum deduction to $1 million with a phase-out increase to $2.5 million. These amounts have been and continue to be indexed for inflation. It used to be available for personal property, but it's been expanded to certain real property expenditures as well, like roofs, HVAC equipment, fire protection, qualified improvement property, and more. These enhanced limits and eligible units of property provide strategic planning opportunities for taxpayers. Fifth and finally, the CARES Act. A technical correction in the CARES Act gives taxpayers the ability to depreciate qualified improvement property using a 15-year life instead of a 39-year life, thereby making it eligible for bonus depreciation. Qualified improvement property is property placed in service as an improvement to an interior portion of a building that's not structural in nature, as long as the improvement occurs after the date in which the building was placed in service. This allows for immediate expensing to many leasehold improvements, renovation products, build-outs, and more. While all of this may sound a little geeky and technical, it can mean a lot of tax savings to you. Most of these opportunities are possible only after a cost segregation study is completed on the building to ensure all components are being depreciated in the most economical way allowed by the tax code. Don't assume this is something that your CPA is going to do for you, because they don't have the ability to conduct a proper 13-point engineering-based cost segregation study. Contact me to get a no-cost, no obligation analysis of your commercial or rental residential property to see what tax savings you may qualify for. If you like what you see, I'll work together with you and your CPA to make sure you get all the tax saving benefits that you qualify for. I'm David Weiner, Mr. Cashflow, CEO of Cashflow Strategies. Please like, subscribe, and comment on this video below, and hit that notification bell to be notified whenever I release a new video episode of my live stream, Mr. Cashflow Live. After all, it's your money. Keep more of it.